Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. You know, expectations for interest rate cuts over the past year have shifted greatly. You know, a year ago, traders were forecasting 6 to even 7 cuts in 2024. Now, those forecasts have been ratcheted back to 1, maybe 2 cuts as inflation remains sticky. So, that question many are asking is, how does that uncertainty impact investment portfolios, and what can be done to help investors navigate that uncertainty? Well, I have on the perfect guest to help answer those questions. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to welcome Burns McKinney. Burns serves as a managing director and senior portfolio manager at NFJ Investment Group. Burns, thank you so much for coming on the show. It's an honor to have you on. Thank you. I can't wait to hear your thoughts on what's ahead for investors. You know, can you please tell us a little bit more about yourself and NFJ Investment Group?
Sure thing, glad to, and I appreciate you having me on. I always say we have a simple story, but we enjoy telling it to anyone who's willing to listen to it. If I tell my family at home, I'm just ranting, so hopefully I get a new audience for my old jokes. I'm based here in Dallas, Texas, as is NFJ Investment Group. I grew up in Texas and lived all over the place. I began my career in finance in 1996, so we're talking about 28 years ago. Spent logged some time in New York, did the investment banking route, worked on some sell side research, and then went back to business school to make a transition to working on the buy side in investment management. And so I began my path on the buy side in 2002. So we're talking about 22 years ago. Spent a few years up in Boston, and then about the time we found out we're having our first kid, my wife and I decided let's get a little bit closer to home, closer to family, and so we came back here, and that's when I started my job at NFJ Investment Group. They hired me at the end of 2005, and those just kind of a snapshot of what we are. NFJ, we're based in Dallas. We're a value-oriented investment boutique. Sometimes folks ask us if it puts us at a disadvantage being located right there in the middle of the country, and what we like to think is, Warren Buffett always says, be greedy when others are fearful and vice versa. And, the way I believe it, it's a lot easier to do that if you put about 2,000 miles between yourself and those others on the coast. So, we're contrarians. We like to buy what's out of favor. We really have a mindset that, there are good deals to be had in the market that are right there in broad daylight. But the key is finding ways to capture those. We like to think of ourselves as the folks who are buying winter coats in the summertime. We all know that that's the cheapest time to buy those coats. But if you look at the data, people still buy them when they're more expensive. Going into winter, and so it's a little bit difficult. It kind of goes against our behavioral biases to zag when others are zigging, and so it's important, we believe, to have a systematic and somewhat of a rules-based approach to help counteract those biases. And so, we have a systematic approach. We're value investors by trade. I think, a lot of what we do just uses a lot of the tried and true, Benjamin Graham type value principles. For starters, we're looking to buy stocks across a diversified portfolio that trade at, lower price to earnings multiples than their peers, than their history, and than the broader markets. And likewise, we use what some refer to as modern value, because although those are really tried and true principles, but we add some twist to it. We've for years we've actually been harnessing big data to do things such as, for example, the customization of industries. It doesn't matter what type of metrics you're using. If you're not using the right comps, then you're not going to get it right. The way I kind of describe it is Zillow. People look at that for their houses, and once upon a time, you put your house on the market, and to price it, you look at the one to your left and the one to your right, and subsequently, Zillow came along and used algorithms to really find the proper comps and cast a wider net to more accurately value those. That's how we like to apply that to stocks. So we're looking for value stocks, and then specifically, we're looking for the types of companies that are generously returning capital to shareholders via dividends, via repurchases.
Okay.
I always like to think it's a stat that I kind of hang my hat on is that if you go back over the last 50 or so years, um, the average, if you just look at say the broader U.S. equity markets, if you do nothing more than just eliminate non-dividend payers, just narrow it down to those that pay a dividend, you already would be generating about 1.5 percentage points of excess
Wow.
return. And then likewise, if you take it the next step and narrow it down to those that are raising their
Mhm.
dividends, then you double that degree of alpha. And so, I just like to stick with the type of names that have better batting averages historically.
Fantastic. I feel as if a lot of times we get away as investors, probably not you because you're very much into value, but when markets are just soaring and shooting to the moon and we got FOMO and all this other stuff, people forget about dividends and the important role dividends play in a portfolio. And markets move quicker than ever. There are going to be pullbacks, there's going to be corrections, and how dividends and those value stocks can really help a portfolio during those times.
For
uh,
sure. They cushion downturns, they reduce volatility in the portfolios, and just it really just gives you an indication when a company pays and raises a dividend of management's confidence in the balance sheet and the direction
mhm.
of future earnings.
Yeah, very good point. So you talked about, you know, your valuations, PE ratio, and so on. When markets are up and everything is lofty, and you talked about, there's companies right in front of us that are on sale and trading at a discount. But is it hard at times, especially maybe during right after COVID and stuff, when multiples are stretched to find good value?
It absolutely can be, and I think one reason, one thing that we try to kind of take advantage of is the fact that we don't try to time the markets. We don't try to get out and then get back in. When you try to be a market timer and actually get out of the market, given the fact that markets over the long term do tend to go up, you have to be right twice on when to get out and then when to get back in. So we do always recommend stay fully invested, perhaps rebalance to your losers and
Mhm.
rebalance away from your winners. And don't try to time it. And as such, just look for what's attractive relative to what the market is giving you.
Very good point. Very good point. I started by talking about inflation. So let's take a step back and look at the macro viewpoint here. And inflation continues to drive market commentary. It just won't go away as much as we may want it to. It's not. Will inflation reach the Fed's 2% target, or do you think it's going to be remain sticky for a while?
Yes and yes is a short answer. Yeah, it's been sticky and it tends to be, but if you look at first of all where we've been and where we are right now, you definitely the trend line is moving in the right direction. We've already gone from 9% to around the 3% range, and it's always been known that that last mile tends to be the toughest mile, and so but it does we caution investors from taking too much out of just individual data points and actually look at the longer term trends that are coming down. If you look at some of the more recent prints, the last 2 or 3 months this year have actually been a little bit more elevated than we saw at the end of last year. But they're also really, if you kind of dig beneath the hood, there are some reasons for that. One of the biggest being is that a lot of what's driving the current numbers has been shelter costs. And those that's the one piece of the data that tends to be stale. People don't update those numbers every week or every month. That tends to oftentimes what you're seeing today is data from a year ago. And so if investors actually take real time data on inflation, again going back to the Zillow come from places like that, and plug that into the equation, then in many ways we're pretty darn close to the Fed's 2% target. And given the fact that probably one of the best predictors of inflation through time is money supply growth. Follow the money, the M2 for money supply. Inflation, money supply growth peaked at all near record highs in early 2021. Sure enough, inflation peaked in 2022. You get about a 12 to 15 month lag, and so if we look at what that money supply growth's been doing over the last 12 months, it's actually been negative for one of the few times in history, which suggests that In many ways, that aspect, that driver of inflation, it's sort of it's already been baked into the cake, so it should continue to trend down. There's some long-term factors that I think will, keep us a little bit higher than we'd been, say, in the prior couple of decades, and it may rebound back up to something closer to more of a 2.5 to 3% level. But nevertheless, we do believe that it's probably coming down more quickly than investors are giving it credit for.
Well, that's music to many people's ears, I'm sure. So, what are some other risks or challenges you are focusing on, you and your team, when you're looking for value plays?
Yeah, probably. I mean, the biggest risks in the market right now, aside from just some sort of exogenous shock, whether it be a geopolitical,
Mhm.
oftentimes recessions tend to be kicked off by energy price spikes, which may be
Okay.
connected to the first group. But probably first and foremost, valuations is something that people say, well, what keeps you up at night? And just near term valuations. I mean, if you got the market trading at above average multiples, just any way you slice it, on price to earnings, price to book, price to revenues, it's pretty rich across. And you have an agreement across metrics, cyclically adjusted PE. Not it's not it's not at bubble levels, but nonetheless, it is a little bit pricey, which suggests that in many ways, investors have really taken to heart that soft economic landing narrative, and such that you really price things for perfection, such that it, not to say that we expect a recession, but if you do have one, I don't think that's really factored into the markets. And if you likewise, if you do, then a lot of these forward earnings multiple or earnings forecasts are going to come down pretty substantially. And so there's definitely sort of the upside downside, potential capture is not quite what it was, say, a couple of years ago.
Interesting. So you don't think that lofty valuations or the higher valuations for the market is skewed by maybe those mega tech stocks, which really aren't terribly overpriced, but some of the tech names out there that, you know, have higher valuations?
That's a great point. And actually, in many ways it is. And I think that's kind of why we like to say, we don't try necessarily get out of the market, but you're always finding opportunities to churn underneath the surface within the market. And, that's exactly correct. If you look at that Magnificent Seven, that's been really the biggest driver of both stock market returns in, say, in 2023, as well as a lot of those high valuations. Whereas you've got sort of a subset of the I'll call them the mundane 493 that by and large hasn't done much over the last couple of years, despite the fact that revenues and earnings have continued to matriculate upwards. And so, if you factor that in, you're getting some better valuations than you once did. What we just need to see, and it seems that this year we've been starting to see, would just be a broadening of investment returns away from some of those big tech winners. But that said, as far as calling a peak on those, I mean, I certainly wouldn't recommend investors, go short on those. I mean, you'd lose money pretty quickly on that. But nevertheless, there are some opportunities outside of that.
Can I quote and use that mundane 493? Uh, that is
Yeah,
fantastic.
absolutely.
Um, I'm going to pivot here. You brought up the Magnificent Seven, so let's talk about that for a second. They kind of had a rough go of it here, and makes you wonder. You're right. I'm not going to call the top. I'm not for the Magnificent Seven. I wouldn't even begin to go there with that. But are we going to see a reversion trade back into value? With interest rates probably remaining higher for longer, that probably will benefit value and maybe hurt some of these tech names. But are the days of the Magnificent Seven driving market performance behind us?
Yeah, I wouldn't necessarily say that their days are behind us, but at the same time, you can't invest backwards, and a lot of the easy money has probably already been made there. And so, looking forward, based on where we are today, I think a couple of things that might actually make repeating their recent returns more challenging are, for starters, exactly as you noted, that interest rates are a little bit higher, and they may be poised to stay a little bit higher for longer than investors had
Mhm.
expected. And typically speaking, when inflation's higher, when interest rates are higher, then investors tend to do better looking at shorter duration rather than longer duration financial instruments. Kind of sort of in layman's terms, that if inflation is higher or if interest rates are higher, then I'd rather be getting that cash today rather than cash that a company expects to generate 5, 6, 7 years down the road. I place more value on what I'm getting right here, right now, and so that could present challenges just as well as the fact that in all of those names, I mean, they have some really great fundamentals, but a lot of those are priced in, and so it's kind of gotten to the point that if you just look at earnings, they have a higher and higher sort of hurdle to impress investors. When a kid's been getting straight A's for period semester after semester after semester, the only way you're going to wild appearance is to get an A plus versus, well, maybe you take a look at some of these names that have been getting C pluses or B's that might actually get a little reward for getting a B plus. And so there's definitely opportunities outside of those. And in fact, I think that given that we've had this era of virtually free money for kind of since the global financial crisis, now that money actually costs something, and we don't expect to see interest rates fall to the near zero levels that they had been at for quite some time. And that flooding of free money is sort of like the equivalent of the old saying is that when the tide rolls out, you see who's been swimming naked. And a lot of companies that aren't earning money or have highly leveraged balance sheets have been able to get away with a lot because of that. Now that rates are a little bit tighter, I think that the markets may actually reward some of these companies that are sitting on true assets and true near-term earnings. And so that could end up shifting kind of a reversion to mean that we've been waiting for a long time for value equities.
Yeah, a bunch of great information there. First of all, I think that's what I'm going to tell my parents about my grades is I always just wanted a C. So when I got a B, B plus, it really made them impressed, and I,
There you go.
got a reward for it. I think that's perfect. Um, Two, a lot of you talked about duration. A lot of people, you know, think duration when they're thinking of fixed income. They don't necessarily associate short duration or long duration with equities. Can you maybe go into that a little bit more and maybe why short duration equities during this time period?
Absolutely. Again, and it is sort of using bond parlance to apply it to stocks, but the same factors apply. I mean, really, a value stock, a stock that's trading at 8 times earnings, meaning that basically a higher proportion of what you're it's based, a higher proportion of what its true valuation is based on today's earnings versus a stock that's trading at 30 times earnings, for which, really you say, well, why you pay 30 times earnings? And you say, well, because we expect them to earn a lot more money in the year, 2030. And,
Mhm.
that bodes well for value stocks. It actually really bodes well for dividend payers because that's actually taking it one step further to its almost more literal sense. I mean, at the end of the day, all a stock really, is technically worth, aside from a promise, is the cash that you're getting from the company. And so if a company that's paying that cash flow out to investors today, then you don't have to worry about what interest rates are. You take that
Mhm.
cash, you collect it, you can reinvest it versus company that doesn't pay a dividend. It's like you're just investing based on a promise. And so that's kind of how we look at things with respect to, with interest rates maybe being a little bit higher. Just focus on the places that you can, get the cash today. And that's we call that train riding money, something you can touch it, you feel it, you put it in your pockets.
Exactly. Perfect. You know, you we talked about higher for longer and interest rates maybe staying elevated here for a while. It's interesting. I recently our one of our brands is the PSN separately managed account database, and it's going on 40 years. So I was doing some research just going back over the past 40 years and looking at the interest rates, back in the 80s, and it's like we don't have it so bad, right, compared to what it used to be. And then, you know, I think we're just so used to having interest rates at zero, 1%. That's not normal, right? Normal historical average is like 4.5%. And, we talk about it being high, but really, is it all that high?
No, I mean that's exactly right. I mean, right now we kind of really have gotten back to what historically would be considered normal. I mean, and to some extent, we've been living in an era again going back to really 2007, 2008, 2009 with this extraordinary easy monetary policy, quantitative easing, whereby I mean, for one, it's been in a world in which it's you kind of do want to get back to normalcy because it's been a world in which savers, really kind of get
Yeah.
squeezed, and it's kind of been subsidizing borrowers for a long time. And like, and when you think about individual companies, those that that take on a lot of debt have been rewarded versus companies with a little bit more steady and stable balance sheets maybe haven't reaped the benefits of it.
Yeah, fantastic. I've been saying for, maybe 2024 might be the year of normalization. Might take a little bit longer, but I feel as if we're getting closer to normalization, whatever maybe that is. So what needs to happen for equities to continue their solid performance? To me, ever since the pandemic, even during the pandemic, equities have been so resilient. They've had these huge rallies when you didn't think, they were going to rally. A lot of that was because of easy money, free money. But what needs to be the drivers moving forward in order for this solid performance to continue?
Yeah, earnings. We've been in a world in which so much of what's been moving the markets has been interest rate policy, and we may be at the cusp of that because if you actually look at the first quarter so far, stocks have actually the first portion of this year, stocks have been doing pretty well. They're up despite the fact that interest rates have been rising, and so
Yeah.
it may indicate that the markets are finally ready to kind of look beyond that and focus on the actual fundamentals of what type of earnings companies are generating. And so far at least the signs have been pretty good. We had a better than expected first quarter earnings season. I think that if you think about, well, what could drive the markets the next step, it'd be solid earnings. It would be increases in productivity, which may drive margin expansion. That is really what these companies need for earnings. And perhaps a world in which if inflation actually does, get tamed a bit, give it, something that might, we might get another leg up if the Fed is, probably not this quarter, maybe, by the end of the third or fourth quarter, able to reduce interest rates. The best case scenario would be if they can reduce interest rates, not because of economic weakness, but because inflation is coming down. And so as inflation comes down, those interest rates on an inflation adjusted basis start to look a little more restrictive. So they say, okay, well, we're going to reduce interest rates, not because the economy needs it, but for better reasons. Simply that 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 we just basically are trying to. It's not so much you're not lowering them to tap on the gas, rather you're lowering them in the form of taking your foot off the brake, which is a little bit of a nuanced difference there.
Yeah, I love it. I love it. Equity sectors. Moving forward, and based on that information you provided about, higher for longer, maybe interest rate cuts, earnings, what equity sectors do you like moving forward?
Well, I mean, not to bore the listeners, but utilities are certainly a place that you might actually look for some opportunities right now, and that's kind of where we've been shifting, toward the end of last year, and it's kind of you have to go back and look at a little bit of history because back at the beginning of 2023, just the whole world said we're going to have a recession this year,
Yeah.
and so everyone was loading up on defensives and fleeing some of the cyclicals, and then later on in the year, as the year progressed, inflation started coming down, and the Fed maybe said, "Hey, we might be able to pivot." Suddenly, just everyone forgot about that recession risk, and the mindset. Everyone started Google searching soft landings, and so as a result, everything just seems to be hunky dory. And if you think about it, well, when the sun is shining, no one's out there buying the umbrellas. Some of the defensives. And so as a result, the defensives were expensive about 18 months ago. Now they're cheap. Some of the cyclicals were actually providing great values, and now they've gotten a little bit expensive as investors are saying, "Hey, let the good times roll. They're going to keep rolling, indefinitely." And so utilities oftentimes do represent one of the more defensive areas in the
Mhm.
market. So you have them for that reason. As a result of the fact that they had, I think it may have been the worst sector last year. It's one of the few times that utilities are trading at a pretty good discount to the broader
Mhm.
market. And finally, if you think about what interest rate policy is doing, if the Fed does ultimately begin to lower rates, and you might see bond yields start to dip down a bit. Well, that does that ends up typically being a good sign for bond proxy type sectors. Utilities are probably one of the primary ones. Suddenly, you know, no one's getting real excited about a 4% utility dividend yield if you can get a 5% treasury yield. But if that treasury yield dips back down, maybe below 4%, then suddenly, or down in the threes, then suddenly those utility yields look a little bit more attractive.
Mhm. Very good. How about, ask you about financials? Financials, I always think's interesting. The yield curve's been inverted. seems like for years now, and that obviously hurts financials and their revenue generating powers. But then we also had that, the regional financial crisis last year, so there's a lot of headwinds there. Financials moving forward, is that a spot that a little leery of still?
It's an area where there's great opportunities, but you have to pick your points. You have to be
Okay.
a little bit choosy because of the fact, first off, we'll say that, people looked at, for example, Silicon Valley Bank or New York Community Bank and said, is this the sign that, ultimately the Fed's raising rates? When are they going to raise them so much they break something? Maybe this is the sign that they broke something. And, best we
Mhm.
could tell, those moves didn't necessarily seem to be systematic. I mean, those were basically individual companies that had, managed their interest rate risk poorly. They were company specific. They weren't necessarily a sign of broader things to come. And as a result, if you look at the entire sector, the financial services sector is still trading at low valuations around where it was at depths of the pandemic. It's on most multiples the cheapest sector in the market, despite the fact that if you look, I mean, you look across the board, a lot of the banks, for example, have been passing some of the most stringent stress tests ever, and so they're sitting on a lot more stable balance sheet foundations than they ever were back in 2007. That said, I mentioned up front that you do need to pick your points because there are some reasons for concern. I mean, oftentimes they're cheap. You're getting paid to take on that risk. That said, you do maybe want to, I don't know if I call it dancing between the raindrops, but I think one thing that you definitely have to be cautious of is that, with office vacancies, with the fact that people still aren't really returning, they haven't returned to offices in a lot of places. There are a lot of commercial real estate loans that do, as they get repriced and renewed, sitting on a lot of banks' balance sheets that definitely do present some risk. And so, we don't necessarily suggest investors just jump right in wholesale, but find those that are maybe a little bit stay more stable footing there.
Fantastic. Awesome, Vern. Such great information and great insights. I love it. Real quickly, fun story. Anything interesting? You're in Dallas. The Mavericks have been doing pretty well. Any fun story interesting? It could be work related, a good story about living in Boston and New York on Wall Street or
Well, and again, you definitely, you gave me the right question as far as the Mavericks. I'm like, I think it's been like 11 or 12 years Mavericks season ticket holder. I was at the almost epic comeback, if you will, on Sunday with my daughter. I love it as a place to share and spend time with my kids. It's kind of interesting, and I'll kind of try to tie that to kind of what we do on a financial basis is that I just kind of it gives me a little bit of lesson in humility is that one of the things that we faced for a lot of our strategies last year is probably one of the biggest detractors, things that maybe didn't work for our strategies wasn't what we owned, but it was what we didn't own. And what we didn't own, namely being Nvidia. I mean, Nvidia just had an absolute another just banner period, another banner first period. It's not a name that we owned. There's one of my mea culpas for the day. But the interesting thing is my kids' grandparents have, each year they give them a small plug that they can invest with, so they can just kind of learn as they go the meaning of actually buying and choosing stocks and investing. And sure enough, I think it's like 2.5 years ago, really before even anyone was even mentioning the words AI, the stock that my 14-year-old son picked was Nvidia. He bought some shares of Nvidia. At the time, it had nothing to do with AI. He bought it because he likes to play video games, and he said, "Well, you know what? They make the best graphic chips for video games." So he was using what he knows, fundamentally speaking, to make his own stock pick. And sure enough, he ended up absolutely hitting a home run to a greater degree than I've done in my professional life. Based on he got it right for the wrong reasons, I guess is the best way of putting it. And that's just I think it's a great example for all of us who try to make a living as stock pickers, know that there's so much uncertainty out there, and in many ways, I hate to say it, sometimes it is like throwing darts, and it kind of teaches us that a lesson in both humility as well as against overconfidence.
it- it's hard. Stock picking is not easy. I love that story. It was probably 10 years ago. I had a family member and she got some money from a grandparent too and came to me. And I was like, well, it's a great way of, it wasn't enough money to do anything crazy, but to educate them on investing. So at the time, she really liked Disney. We I bought her Disney, and it did really well for that 10-year time period. And then we took her to Disneyland, and she was walking around Disney saying how she owns Disney and all that.
Oh,
So it
I
is
love it.
just a fun way of teaching them about investing, and
Sure.
especially if they're making money, like in your son's case, where maybe NFJ is going to have to start up a growth arm and have him become the leader.
There you go.
Awesome, Burns. Where can our audience get more information about NFJ Investment Group?
Sure, and I appreciate the opportunity to maybe raise some funds and pay the bills. I guess there's a couple of ways. For starters, they could just go to our website, which is nfjinv.com. We're an affiliate of Virtus Investment Partners. Or if they just want to kind of just look up one of the funds, I won't give everything, but our flagship strategy, our dividend value fund, which as you can just tell by the name, it incorporates a lot of the principles that I spoke about earlier in the show. It's one that we've had since the firm's inception back in the 80s. So it's got a great long-term track record. For the Class A shares, the ticker for that is PNEAX. The institutional shares are NFJ EX. But probably the best way to do is just to go to our website, nfjinv.com, and reach out to us, and we're happy to tell the story for anyone who'll pay attention to us.
Fantastic. I will go ahead and put that website link in the show notes so people can find it. Burns, thank you so much for coming on the show. It was really a fun conversation. I learned a lot. Very, very enlightening and insightful. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you and have a great rest of your week.